Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss a future episode, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Oswald Oduntan, Investment Manager for the Managed Portfolio Services based out of our London office. And this week, I am pleased to be joined by regular podcast guest Richard Carter, our Head of Fixed Interest Research, and David Denton, our Technical Consultant. Now, last week, the UK Chancellor Rachel Reeves unveiled the much-awaited autumn budget, where she outlined key changes to things such as capital gains tax, unused pension pots being brought into scope for inheritance tax from April 2027, business relief removed from AIM stocks, now a 20% levy applies, agricultural property relief reforms to employers' national insurance, which was raised by 1.2%, and non-dom regime also changed from 2025, which is a lot to take in. So, Richard, after reviewing the budget and OBR reports, bond investors have raised their expectations regarding the UK's borrowing plans. Tax revenues expected to rise by an average of 36.2 billion every year for the next 5 years. However, government spending is also projected to average around 70 billion annually over the next 5 years, which is mainly going to happen through debt issuance in the UK gilt market. So, Richard, can you explain the developments in the bond market following the budget?
Yeah, I think there's sort of two things going on, really. The first obviously is the extra borrowing. Despite all the talk from Labour in the run-up to the election that they'd learned the lessons of Liz Truss, they weren't immune to doing some quite big increases in borrowing, which the market wasn't too happy about. And to be honest, I know we've got all these fiscal rules and the OBR pronouncing on each budget, but the fact that they keep changing the fiscal rules, this wasn't the first time, doesn't exactly help in terms of some of the sort of credibility. So yeah, gilt markets didn't like that. More bonds to digest over this year and into the future. And then obviously the other thing is that if they're going to borrow more money now and then invest that in whatever infrastructure, but also invest in public services, that potentially increases the growth rate in the short term. So by doing that, all things being equal, reduces the chances of the Bank of England cutting rates aggressively. So that was the main thing. We mustn't forget what's going on globally. We've got a US election this week. The bond market's a bit worried about what happens if Donald Trump gets in. You had some mixed data in the US. So there were other things going on last week, but you've definitely seen UK bond markets underperform relative to Europe and the US recently, and that's basically as a result of the budget. But it's not a sort of return to the Liz Truss mini budget time. We've got a different backdrop really. Inflation's lower, interest rates are already high and are probably on the way down. And a lot of those strategies that we had last time that caused all the problems, the LDI strategies, have got much less leverage now and bigger buffers. So different world and sort of not such a big a reaction as during the sort of Liz Truss time. But yeah, gilt market's not too happy with the budget.
Agreed. The reaction wasn't as dire, especially with the pound, which didn't drop as much relative to the Liz Truss crisis. And just more in terms of inflation expectations and interest rates, you're saying that it's not going to be as an aggressive cut. But what are your thoughts on the future trajectory of interest rates going forward?
Yeah, they should still come down. including this week, and these, the sort of forecasters and economists at the Bank of England will have to look at it and work out, how much this will affect their rate cuts in the future. And certainly, markets now pricing in sort of 4% base rate, sort of roughly this time next year, which is probably one or two cuts less than it was a few weeks ago. So yeah, rates are still on the way down, but it's not going to be as aggressive potentially as it was before. all kind of all things being equal. I mean, what I would say on a slightly wider point is that they borrowed all this money, they're raising all the taxes, and the expectations for growth in the economy long term haven't really changed. Improving productivity, and really, if you are going to get debt down, deficits under control long term, you need to raise the sort of growth rate in the economy. And despite all the measures, that doesn't seem, most people don't think it's really going to change much for the better. And I think that's long term the bigger concern.
Thanks, Richard. Now, moving on to David, you've been occupied with analysing the budget, and you will be continued to do so in discussions about it over the coming weeks. So, whilst we have you here, first question for you: from a personal financial planning perspective, what were the big surprises on the upside and downside?
Yeah, Oswald, it was a really long run into the budget, wasn't it? So we know it's the first Labour budget for 14 years, and the election was in the first week in July, and we didn't get a budget to the 30th of October. And that, of course, allowed the press to be hyperactive, and apparently anything that could have changed was going to change. So I think there are actually some pleasant surprises, the things that didn't change, and it's worth mentioning those. So, for example, with pensions, which are very generous in terms of how we can save for our retirement, we can still get full tax relief at our highest marginal rate. A lot of people were concerned about the pension commencement lump sum being downgraded, and might have been a maximum of 100,000. Well, nothing changed there at all. And for capital gains tax, for example, yeah, there were changes, but we still have private residence relief. So we sell our main property and there'll be no capital gains tax. And I'm a little bit surprised, but we still have the uplift on death. So when we pass away, any gains are effectively washed out for the new owner. And all of those were rumours that were really unsettling some people in the market and driving perhaps suboptimal behaviours. And then for inheritance tax, which was another tax that was up for grabs, so to speak, real concern that if you made a lifetime gift that would normally take 7 years to leave your estate, well, that still works after 7 years. The rate hasn't changed. And another concern was that if you left wealth to your spouse or civil partner, there may be a limit to what you can give, because right now it's all free from inheritance tax, though on the second death tax is collected. So in reality, lots of the things people were worried about didn't come to fruition, but there were a few big things from a personal financial planning perspective that have happened. One of them might be that capital gains tax rates have come up. So for savings and investments, and now property that isn't covered by private residence relief, the rate for a basic rate taxpayer is 18%, and for a high rate and additional rate taxpayer, that's now 24%. But in reality, for a high rate taxpayer, that's quite a modest increase. So 24%, still a lot lower than the rate of income tax, which could be as high as 40 or 45%. So yeah, it's not been helpful, but it's not been disastrous either. So lots of things have been tinkered with, including pensions and inheritance tax, and pensions and inheritance tax have actually been connected as well. So we now have this notion that upon our demise, and this kicks in from actually 6th of April 2027, so several years out from now, then majority of pensions where value is left to a beneficiary, if that beneficiary isn't a spouse or civil partner, there will be potentially some inheritance tax. So that's probably one of the biggest changes that's been talked about in the press right now, and alongside other changes around limiting the advantage of investing in assets for business relief and agricultural property relief, whereas unlimited value could be sheltered from inheritance tax. Generally speaking, you're going to have a 1 million limit per person at full relief, and the remainder limited to 50% relief, so 20% tax. And for some assets, such as AIM portfolios, there won't be a million free, so to speak. It'll be stationed as the 50% benefit, so 20% tax liability. So yeah, there have been a fair few changes, and some of them interlink. And it's vitally important to get the modelling right to understand how that works. And generally speaking, though we'll want to do modelling for clients, we shouldn't rush. We need to see the full and final detail. On some of these things, there are consultation.
Thanks, David. Final question for you. Given that the ISA subscription limits are frozen until the 5th of April 2030, what alternative investment options are available to clients looking to maximize their tax-efficient savings?
Yeah, that's a good question. I mean, lots of reliefs have been frozen for a couple more years. And quite naturally, people with excess liquidity will be thinking, what do I do next? Now, I'm actually going to go back on a previous comment, and I talked about capital gains tax. And capital gains tax is still charged at a lower rate than income tax. So assets that bear capital gains still aren't a bad place to be. Quite clearly not as good as an ISA, but capital gains bearing assets can be quite enticing. And on top of that, given the situation with gilts hasn't changed, so when we have coupon, the interest that comes from gilts, that's taxable to income tax. But right now, of course, buying short-dated gilts, we're looking at capital appreciation. And capital appreciation of gilts, we know, are tax-free in the hands of individuals. And that can be really appropriate if we're looking for higher and additional rate taxpayers. Short-dated investments, capital growth being tax-free, does put you in a really strong place, especially because of the gross redemption yields that are pretty attractive right now. And I guess there are other things you can do as well. If you're not funding the pension to the maximum ability, full tax relief is still available. So actually, Oswald, still plenty to talk about.
Which is good news. Thank you, David. And if you're interested in hearing more from David, he will be speaking in several webinars. The first session, which is aimed at clients and prospective clients, will be on Friday, the 8th of November, addressing the key impact on their finances. And then on the 14th of November, he will be discussing the impacts for advisors and paraplanners. Finally, if you've missed our latest episode of Taking Stock After the Bell, we were joined by Adam Smith, former Chief of Staff to the Chancellor of the Exchequer, to discuss key changes. Thank you both for your insights today, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now wherever you're listening, and share it on your socials and tag us at QuiltAchievia. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week, but in the meantime, head over to our website, www.quiltachievia.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for the next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. So thank you, Richard and David, for your time, and to all of you for listening. See you next time.